Pause whatever you are doing right now and pay very close attention to what I am about to walk you through, because while you have been watching the price ticker, while you have been scrolling through social media and reading the headlines, something deeply significant has been unfolding beneath the surface of this Bitcoin market that the mainstream financial press is simply not putting together into a coherent picture for you. Bitcoin just lost roughly 5% of its value inside a single trading session, falling from the $67,000 range straight down towards $64,700. And the reflexive response from most commentators is entirely predictable. Volatility is normal, crypto is risky, zoom out and hold. But that framing is incomplete, dangerously incomplete, because this is not random market turbulence. This is not retail emotion pushing price around in the dark. When you drill into the on-chain architecture, the actual transaction-level data that institutional desks monitor around the clock, you find a very specific, very deliberate fingerprint on this move. And that fingerprint tells a story that every serious market participant needs to understand right now before they make the wrong decision at exactly the wrong moment. I am your host at Bullion Finance News, where we do not guess, we do not follow the crowd, and we do not repeat what everybody else is already saying. We interrogate the data, we build the complete picture, and we give you the kind of structured, evidence-based analysis that actually matters when real money is on the line. Today we are going deep into Glassnode, into CryptoQuant, into exchange flow mechanics, stablecoin liquidity dynamics, and the macro rotation that is happening across every major asset class simultaneously. All of it assembled into one complete framework so that by the time this is over, you will understand exactly what is happening in this market and exactly how to think about it. Before we go any further, this video is produced strictly for educational and informational purposes only. Nothing you are about to hear constitutes financial, investment, or trading advice of any kind. Always conduct your own independent research and consult a licensed financial professional before making any investment decisions with your own money. Now let us get into it. Every significant price move in Bitcoin carries what experienced analysts call a structural fingerprint. It is embedded in the on-chain data, in the movement of coins across wallets and onto exchanges, long before the price action becomes obvious to the average observer. Right now that fingerprint is unmistakable, and it is pointing in one very clear direction. CryptoQuant maintains a metric known as the exchange whale ratio, and the mechanics of it are straightforward. It measures what percentage of the total Bitcoin flowing onto exchanges on any given day is being driven by the 10 largest individual deposits. When that ratio is low, it means regular market participants, retail investors, smaller holders, are the ones primarily moving Bitcoin to exchanges. That is the background rhythm of a healthy functioning market. Normal activity, normal noise, nothing to be alarmed about. But when that ratio is elevated, when it climbs significantly, it tells an entirely different story. It means the largest, most sophisticated holders in the entire ecosystem, institutions, long tenure early adopters, high net worth entities who have been in this market for years or even decades, are the primary force driving exchange inflows. And when entities of that caliber move Bitcoin to an exchange, they are not doing it to admire the user interface. They are doing it because they intend to sell. Here is what the current data is showing right now. The exchange whale ratio has climbed to 0.64. That is the highest recorded reading since 2015. Let that land for a moment. We have not seen dominant whale-driven exchange inflows at this magnitude in over a decade. Nearly 2/3 of every single Bitcoin arriving at exchanges right now is traceable to the 10 largest daily deposits. These are not scared retail participants making an emotional decision at 2 in the morning. These are calculated, deliberate, large-scale liquidations being executed by the most sophisticated actors in this entire market. Entities that have access to far more information than the average investor, that have spent years building positions through multiple cycles, and that are now choosing with full conviction to convert those positions into exchange liquidity. The question that should be occupying your analytical attention is not whether this is happening, because the data confirms it is. The question is, what do they know, or believe they know, that is driving this level of coordinated distribution at precisely this moment? Now let us look at the other side of this equation, because every seller needs a buyer, and the picture on the demand side of this market is just as important to understand. Glassnode tracks a metric called the 7-day exponential moving average of net realized profit and loss for short-term holders. And in plain language, what this measures is whether recent buyers, people who acquired Bitcoin during the latest bull cycle somewhere in the range of $70,000 to $100,000, are currently booking profits when they sell or locking in losses. On February 6th, this metric registered negative $124 billion on a single-day basis. That means on one trading day, recent Bitcoin investors collectively crystallized more than $1 billion in realized losses every single day. Over $1 billion in losses being locked in by people who entered this market, trusting the momentum, following the headlines, and buying near the top of the cycle. Since that date, the figure has improved somewhat. As of the current reading, it has pulled back to approximately negative $480 million per day. The acute phase of panic appears to have cooled. The the volume of distressed selling has declined meaningfully from its peak. But here is the critical nuance that most analysts right now are completely glossing over. The number is still negative. It has not turned positive. Recent buyers are still underwater. They are still selling at a loss every single day. The bleeding has slowed, but it has not stopped. And in market cycle analysis, this pattern has a very specific name. It is called a base building phase. A base building phase is exactly what the terminology implies. The market is attempting to establish a stable price floor, a level where consistent, genuine demand begins to outpace the residual selling pressure from holders who bought at higher prices. Until that floor solidifies, until the realized profit and loss for short-term holders turns constructively positive on a sustained basis, the underlying price structure remains fragile and vulnerable to further downside. We are still in that phase right now. We have not exited it. And it is essential that you understand what that means for the risk profile of this market. Let us now add the next analytical layer to this framework, because exchange flows tell us even more than just the headline numbers. During the sharpest phase of Bitcoin's February correction, when price was compressing toward the $60,000 zone, CryptoQuant data documented exchange inflows surging to approximately 60,000 Bitcoin per day in aggregate. To put that in concrete terms, 60,000 coins representing billions of dollars in market value were entering exchanges on a daily basis. When that much Bitcoin hits exchanges in that compressed a time frame, the market has almost no mechanical capacity to absorb it without price conceding lower. Supply overwhelms demand. Price falls. It is basic market structure, and there is nothing mysterious about it. Since that peak, the daily smooth figure has retreated to approximately 23,000 Bitcoin. The flood has downgraded to a more manageable stream, and that is a directionally positive development worth acknowledging. But here's where the analysis becomes significantly more nuanced and considerably more concerning at the same time. While the volume of exchange inflows has decreased, the average size of each individual deposit has moved in exactly the opposite direction. Average deposit sizes are now registering at levels last observed in mid-2022. For anyone who lived through that market period, those three words carry enormous weight. Mid-2022 was the epicenter of one of the most severe and sustained bear markets in the entire history of Bitcoin. Price collapsed from $48,000 all the way down to $16,000 over the subsequent months. During that entire devastating decline, elevated average deposit sizes were one of the consistent on-chain warning signals that sophisticated sellers were methodically liquidating into whatever available bid liquidity existed. The parallel between then and now is imperfect. No two market cycles are identical, and history rhymes rather than repeats verbatim. But when that specific structural pattern resurfaces, the intellectually honest response is to take it seriously and adjust your risk framework accordingly. Here is something that most Bitcoin-focused analysis right now is completely failing to incorporate into the picture, and that is what is simultaneously occurring across the broader altcoin ecosystem. CryptoQuant data reveals that average daily altcoin deposits to exchanges have risen to approximately 49,000 transactions per day across 2026 to date, up from roughly 40,000 per day during the final quarter of 2025. That is a meaningful and statistically significant increase in distribution activity across the entire alternative cryptocurrency market. Why does altcoin behavior matter when we are talking about Bitcoin? Because altcoin deposit activity functions as a leading indicator of aggregate market risk appetite. When participants across all segments of the crypto ecosystem are simultaneously moving altcoins to exchanges in increasing volumes, it signals a broad reduction in risk tolerance across the board. It signals that holders are preparing to exit their positions, that the appetite for speculative exposure is contracting, and that the overall market is transitioning into what analysts characterize as a distribution phase. Distribution phases, by definition, are characterized by two specific market conditions: elevated volatility and weakening risk appetite. Neither of those conditions is constructive for a Bitcoin recovery thesis, and the critical thing to understand here is the simultaneity of it all. Bitcoin is not facing isolated selling pressure while altcoins remain stable and healthy. The entire asset class, Bitcoin, Ethereum, and the broader altcoin spectrum, is experiencing coordinated distribution simultaneously. The headwinds are systemic, not sector-specific, and that changes the recovery calculus considerably. Now we arrive at what I genuinely believe is the single most underappreciated signal in the current market environment: the factor that more than any individual metric defines the structural vulnerability of Bitcoin's price at this specific moment in time. And almost nobody in the mainstream crypto commentary space is discussing it seriously. I am talking about stablecoin liquidity. And to understand why it matters so much, you need to understand the fundamental hydraulics of how this market actually functions at its core. Stablecoins, USDT, USDC, and their counterparts represent purchasing power in its most liquid and deployable form. They are the capital that buyers load onto exchanges when they have decided to acquire Bitcoin. When stablecoin inflows to exchanges are high and growing, it means buyers are actively positioning themselves. They are loading up their accounts with buying ammunition. Demand is mobilizing. The market has the fuel it needs to absorb selling pressure and push prices higher. When stablecoin inflows contract, the inverse is true. Buying power is draining out of the system. And when that buying power drains at the same time that sophisticated sellers are aggressively distributing, you have a recipe for structural vulnerability that the headline price number simply does not capture. CryptoQuant data shows that net USDT inflows to exchanges reached a 12-month high of $616 million back in November, during the peak of the bull run when Bitcoin was printing new highs and price momentum was fully engaged on the upside. Buyers were flooding exchanges with purchasing power. The demand was real, it was substantial, and the price action reflected it in every direction. Now look at where those same stablecoin flows stand today. Net USDT inflows have collapsed to approximately $27 million. And in late January, this figure briefly turned negative, meaning more stablecoins were actually being withdrawn from exchanges than were entering them. That is not a neutral reading, that is not just a slowdown. When stablecoins are net flowing out of exchanges, it means market participants are not merely sitting on the sidelines waiting for a better entry point. They are actively withdrawing their purchasing capacity from the market ecosystem entirely. The army of buyers that would need to step in to absorb continued whale selling to catch the price and build a floor is not merely smaller than it was in November. At certain recent moments, it has been actively shrinking in real time. Bitcoin is currently trading around $65,000, and the liquidity architecture beneath that price level is extraordinarily thin. The depth of genuine buy-side demand required to arrest a meaningful sell-off has been eroded to a degree that should get every serious investor's attention. This is what market analysts mean when they reference reduced marginal buying power. It does not suggest that Bitcoin's long-term demand story has changed. It means that in the current moment, in today's specific market configuration, there are insufficient buyers available at these price levels to confidently defend against a continuation of the whale-driven selling pressure we are currently observing. This brings us to the pivotal question that every Bitcoin participant needs a clear-headed, honest answer to right now. Can Bitcoin hold $65,000? This price level has emerged as what traders call a near-term pivot, a structural line of demarcation that will largely determine the character of the next major market phase in either direction. If Bitcoin holds here, if the selling exhausts itself at this level and demand gradually reasserts, then $65,000 becomes the foundation upon which a recovery phase can be constructed. Price consolidates. Confidence slowly rebuilds. Stablecoin inflows begin recovering as sidelined capital cautiously re-engages with the market. If this level breaks, if the combination of whale distribution, thin stablecoin liquidity, and the macro conditions we are about to discuss overwhelms the available buy-side support, then the consequences are more significant and more painful. Below $65,000, stop-loss orders trigger. Leverage long positions face liquidation calls. Algorithmic selling systems accelerate the decline. The market has to reach deeper, lower levels before finding the genuine demand density required to establish a functional and durable floor. Here is the unvarnished truth that rigorous analysis demands you hear. No analyst, no on-chain data service, no institutional research desk, and certainly not me, can tell you with certainty which of those scenarios unfolds from here. The data gives us probabilities, structural context, and pattern recognition. It does not give us guaranteed outcomes. What the weight of the current evidence does tell us is this. Whale selling is dominant at a decade-high level. Retail distress has moderated but has not stopped. Exchange flows are elevated by historical standards. Altcoin distribution is broadening across the ecosystem. Stablecoin liquidity has collapsed from its peak by over 95%. That is not a bullish picture. That is the picture of a market under serious structural pressure actively searching for its floor. Now let us talk about what is happening in the broader financial landscape because it is directly connected to every conclusion we have drawn from the on-chain data, and it is amplifying the headwinds rather than counteracting them. As Bitcoin has pulled back roughly 5%, gold has simultaneously appreciated approximately 2%. Silver has surged an extraordinary 5.6%. U.S. equity index futures led by the Nasdaq 100 are in negative territory by nearly 1%. This is not coincidence, and it is not isolated noise. This is a coordinated signal visible across every major asset class simultaneously. Professional investors right now are executing a classic risk-off rotation, moving capital away from high-volatility, growth-correlated assets like technology stocks and cryptocurrencies, and directing it toward traditional safe haven instruments like precious metals and defensive assets. This macro rotation has direct implications for Bitcoin, and it connects to a narrative that has been absolutely central to the Bitcoin investment thesis for years. Bitcoin bulls have long argued with considerable intellectual merit that Bitcoin is digital gold, that it will eventually function as a store of value, a hedge against monetary debasement, and a safe haven asset during periods of economic stress and uncertainty. The argument has real merit, and the fundamentals supporting the long-term version of that thesis have not disappeared. But in this specific market moment, in this current short-term window, the data is telling a different and less comfortable story. Bitcoin is behaving like a risk asset. It is declining alongside technology stocks. It is moving inversely to gold. It is responding to risk-off sentiment the way equities respond, not the way gold responds. That behavioral reality in this specific macro environment creates additional headwinds for near-term price recovery that layer on top of everything we have already discussed from the on-chain data. When institutional capital is rotating defensively, speculative and risk-correlated assets face structural selling pressure regardless of what their long-term investment thesis looks like. So let us now put all of this together into something actionable, because data without a decision framework attached to it is ultimately just interesting noise. If Bitcoin successfully defends the $65,000 level from here, the more constructive scenario begins to unfold. The current wave of whale distribution gradually exhausts itself because even the most sophisticated institutional sellers eventually deplete their available supply. Short-term holders who needed to exit have largely already done so at this point. The acute selling pressure dissipates. As price stabilizes, a subtle but important shift begins to occur in the flow data. Stablecoin inflows recover modestly. Patient long-horizon institutional capital, the accumulation buyers, the funds with multi-year mandates, begins to recognize the value proposition at these price levels and quietly starts building positions. Exchange inflows decline further as selling pressure reduces. The whale ratio normalizes back toward historical averages. In that scenario, Bitcoin does not simply reverse sharply and race immediately back toward all-time highs. What typically happens, what the historical record across multiple complete Bitcoin market cycles consistently demonstrates, is a grinding patience-testing consolidation phase. Price oscillates within a relatively contained range for weeks or potentially months. The market digests the preceding correction. Weak-handed holders continue rotating out. Strong conviction buyers accumulate at the lower end of the range. And eventually, when the base is sufficiently built and genuine demand has rebuilt to a level that can absorb supply, the next directional move begins. If you are a long-term holder with a multi-year investment horizon, this scenario is entirely manageable. It is uncomfortable, it is slow, it tests your conviction, but it does not invalidate the underlying thesis that brought you to this market in the first place. The scenario nobody wants to discuss, but everyone needs to have a plan for, is the opposite one. If the thin stablecoin liquidity we have documented proves insufficient to absorb continued whale distribution, if price breaks below $65,000 with meaningful volume and conviction, the consequences cascade in a very specific and familiar way. The technical break triggers automated responses across the market. Stop losses activate at levels that were set by holders who bought higher. Leveraged positions face liquidation calls that force additional selling into an already pressured market. Algorithmic systems that are programmed to sell into momentum accelerate the decline further. Price moves into a deeper correction, searching for the next genuine demand zone where buyers with real capital and real conviction are willing to step in and absorb the available supply. This scenario is painful. It is also not unprecedented in any way. Every major Bitcoin correction in history felt catastrophic and potentially permanent to the participants who were living through it in real time. The 2013 crash felt like the end. The 2017 to 2018 collapse from $20,000 felt like the end. The March 2020 COVID flash crash felt like the end. The 2022 bear market that took price from $69,000 all the way to $15,500 felt definitively like the end to many people who were invested in it. And in every single one of those episodes, without exception, the people who had sized their positions appropriately from the beginning, who understood their time horizon clearly, who had a plan for the downside scenario prepared before it unfolded rather than during it, those people navigated through successfully. Many of them came out the other side with life-changing results. The critical variable is not whether a deeper correction occurs. The critical variable is whether you have thought through your response to it before it happens. This is also a good moment to be completely clear about something important. Nothing in this analysis is personalized financial advice. I am not a licensed financial advisor, broker, or investment professional of any kind. The frameworks I am sharing are educational perspectives on risk management and analytical decision-making, not instructions for what any individual investor should do with their own money. Your financial situation, your risk tolerance, and your investment objectives are unique to you, and they require personalized guidance from a qualified professional. Please treat this content as education and conduct your own research accordingly. With that said, here is how rational, experienced market participants tend to think about periods of stress like this one. The first and most foundational thing is knowing your time horizon and actually respecting it in your behavior, not just in your stated intentions. The current on-chain data structure creates an environment where short-term price prediction carries exceptionally high uncertainty. False breakouts and sharp reversals are common features of base-building phases. The environment rewards patience and punishes aggression from underprepared participants. If you are approaching this market with a multi-year investment horizon, the calculus differs substantially from someone trying to trade the short-term swings. The fundamental investment case for Bitcoin has not been altered by a 5% weekly decline. Keep those two things, short-term market structure and long-term investment thesis, clearly and rigorously separated in your analytical framework. Position sizing is not just a tactical consideration in speculative asset markets, it is an existential one. The most important rule in volatile asset investing is not timing the market correctly. It is ensuring that your position size is calibrated so that even in the worst plausible scenario, a 30, 40, or 50% drawdown, you are not forced into a position where you must sell to meet financial obligations or because your psychological breaking point has been reached. The investors who have consistently generated outsized returns in Bitcoin across multiple complete cycles share one common trait above all others. They sized their positions such that they could hold through the pain without being compelled to exit at the worst possible moment. The other thing worth building into your analytical toolkit is fluency in on-chain data rather than just watching price charts. Price charts tell you what has already happened. They are the rearview mirror. On-chain data, exchange flows, wallet behavior, realized profit and loss metrics, stablecoin flows, gives you a structural view into what is actually happening inside the market in real time. What the sophisticated money is doing, whether supply pressure is intensifying or beginning to exhaust itself, whether genuine demand is rebuilding or continuing to drain away. Glassnode and CryptoQuant are not perfect forecasting tools, and no honest analyst will claim they are, but they provide an informational context that dramatically improves the quality of the framework within which you make decisions, and that informational edge compounds over time. Of all the metrics discussed today, the one to monitor most closely as a forward-looking signal that conditions are shifting constructively is net USDT inflows to exchanges. When that figure begins recovering consistently, when buying power starts genuinely returning to exchange infrastructure and moving away from the near zero and occasionally negative readings we are currently observing, that is your earliest structural evidence that the base building phase may be concluding and a genuine recovery phase may be beginning. You do not need to catch the exact bottom tick. Attempting to time the absolute low is a game that costs more in missed opportunities and psychological damage than it ever saves in improved entry price. What you need is clear evidence that structural demand is genuinely returning to this market. The stablecoin flow data gives you that evidence before the price move becomes obvious to the majority of participants. Let me close with the perspective that the full historical record of this asset demands, even within a rigorous analytical framework, because context across cycles is not just emotionally comforting, it is analytically important. Bitcoin has been declared dead more than 400 times across its existence. Every major correction in Bitcoin's history, from 2011 through 2013, through the catastrophic 2017 to 2018 decline from $20,000, through the COVID flash crash of March 2020, through the prolonged 2022 bear market that took price from $69,000 down to $15,500, every single one was accompanied by the same narrative. This time is different. This time Bitcoin will not recover. This time the market structure is fundamentally broken. That narrative has been wrong every single time. The individuals who understood the long-term structural case, who had sized their positions appropriately to survive the drawdown, who had the financial and psychological resilience to hold through the discomfort, those investors have been the consistent winners across every single cycle without exception. Is this cycle different? Could this be the exception? Financial markets are probabilistic environments, and certainty does not exist in either direction. Intellectual honesty requires acknowledging that. But the structural investment case for Bitcoin, the fixed 21 million supply ceiling enforced algorithmically rather than by human discretion or political decision, the genuinely decentralized network architecture that removes single points of failure and control, the growing global institutional recognition of Bitcoin as a legitimate asset class, the macro tailwinds created by persistent central bank monetary expansion and its long-term implications for hard asset stores of value, none of that fundamental architecture has been changed by this week's price action. What has changed is the short-term market structure. And right now that structure says be thoughtful, be patient, be well-positioned before events unfold rather than during them, and above all else, be informed. That is exactly what we do at Bullion Finance News. We do not guess. We do not follow the crowd. We do not repeat the same surface-level commentary that every other channel is already giving you. We interrogate the actual data, the transaction level, wallet level, exchange level information that the most sophisticated participants in this market rely on. And we build the clearest and most honest picture we can of what is actually happening beneath the surface. If this analysis gave you a sharper, clearer view of where this market genuinely stands right now, do one thing before you go. Hit that like button, subscribe to Bullion Finance News, and turn on notifications so you are there every time we drop an analysis like this one. Because in markets like this one, being informed is not optional. It is your single most important competitive advantage. We will see you in the next one.